Alrighty. So I guess let's get started with today's session. Welcome everyone. Today is our session number 232. Yeah, we've been around the corner for some time now. Almost 4+ years, meeting every Saturday, and sometimes more than once a week. So thank you for all the patience that you have shown over last 4 years in in dealing with me and and sparing your time 2.5 hours. And for those who also join Wednesday session, it's almost like 5 hours per week with me. So really appreciate it, and that's a motivation for me to keep going. We need to find a way to invest in cricket teams. Only betting. Yeah, I don't know. Yeah, sports is, I mean, it is becoming bigger as a investing in. I mean, it's become a much bigger economy in India, but it's still fractionally very small as compared to, let's say, in US or in Europe. Uh, but that reminds me, I think one of European soccer club, right, has is kind of gone bankrupt, and now one of the I think it's Oak Tree, not Oakmark, but Oak Tree. They are now became owner of the football of the soccer club. I have to distinguish between football and the soccer. So they ended up, and I was just wondering, I'm like, what is Howard Marks doing by owning this soccer club in Europe? Then I realized that they had a kind of a loan, um, basically provided a credit to the soccer club, and when if you can't repay your creditors, they own you, and that's what happened. So I don't know what Howard Marks is going to do, but that's a new story. Okay. All right, let's get going. First, our state of the market. S&P is like new records this year, right? It's in 2024, in first half of 2024, we had what 30 new all-time closing highs in 2024. So if you just average it out, it's like 5 new highs per month. Now that's crazy. And in this last 23 years, in this century, it was only in 2021 when the markets were like really crazy because of all the free money, inflation so down, and also a lot of stimmy checks which found its way into the stock market. Those were the crazy times. That was the only year in last 23 years when in first 6 months we saw so many number of new all-time closing highs in on S&P 500. So as an investor, it's a great news, for us to stay invested. And despite whatever macro forecast or anything that you might hear on financial media, or you read it in newspapers, right? Every once in a while, someone's prediction will come true. But market chugs along. There are years when it won't do anything. There are years where it will go negative. But overall, economy moves forward, and so does the market over a long period of time. Uh, you know, it's based on what's the economic value that businesses create. That's all the stock market is. So congratulations if you have stayed invested. It's first half almost up 15%. What more can we ask for? The current bull run, and I guess the bull run had started when in October 2022. That was probably the low point, and after that it's almost more than 18 months we are into bull run, and it has added more than $16 trillion in market value. Yeah, since October 12, 2022. Imagine market had bottomed at 357 SPY or SPX like 3577. Imagine throwing the towel in your, throwing up your hands and in desperation and saying, you know what, I'm going out. From almost 3,500 to 5,500. That's what uh, us makes is how much percent? So you got almost 2,000. That's 57%. 57% gain from October low till now. And we're talking about, just S&P 500. Doesn't need any special IQ or any special skills to invest and gain 60% in whatever 18 months. Forget about the fact that, oh, I didn't catch AI wave. I was late in that. I didn't realize that Meta is going to be such a, multi-bagger. Meta was what, 88? It's low, somewhere around that 88, maybe 90. Now it is like 500 plus. Forget about all the stuff. Forget about, you know, uh, trying to forget about not getting on to the AI bandwagon or not capturing the best stocks or getting laid on the GLP-1, right? Eli Lillies of the world. Even if you had just, let's say, if you had just done an automatic investing via your 401k or on your brokerage and had gone on vacation with no access to internet, you would have still done great. Right? Just to S&P 500, that itself is up like 60%. Can't ask for more. Looking at a sector this year, so this year S&P is almost up 15% sector wise. Of course, information tech and communication services continue to be the top sectors, just like in 2023. 2023 QQQ was up what, 50% or so. Now it's already up. Let's see, where's QQQ. Shouldn't be up close to 20%. Qs are up 19% for the year. And we have 6 more months to go. So there's still more chance. I'm not saying that it's gonna go up, but I mean, still 19% is way better than fixed income. I mean, you can make what, 5% in fixed income with almost no risk because on treasuries. Or if you want to go a little higher on the risk side and get corporate bonds, you can make 6-7%, right? 15%, and that's what you get paid for. But it doesn't come. I mean, I probably make it sound like very trivial, saying you could have just invested in S&P and forgotten about everything. But it's not easy because you have to go through 18% drawdown. Not, I think it was what, 22% drawdown that we saw in 2022. Those are like your stomach churning drawdowns. So you have to go through 30% drop during the COVID. So it's I always say it's investing is more about EQ than IQ. You don't need any. I mean, I don't need to. I'm not from financial services industry. I'm not an accountant or a CFA. You don't need to be. Right? To invest, it's easy to invest. Staying invested is where I think it's much difficult because we have to go through these drawdowns. That's where I guess we need to have a stronger stomach than a stronger brain to stay in the market. Aditya asks, any thoughts on splitting investment between S&P and QQQ? I mean, it is person to person. Now, if you say QQQ has top 100 by market cap companies in NASDAQ stock exchange. Uh, NASDAQ is known for, NASDAQ, it's a home for many of the technology companies. So QQ, I mean, it's not all are the tech companies, but majority of the tech companies would like to list on NASDAQ. They have a little more relaxed rules on listing. So QQQ is considered as a proxy of the tech sector. Now it's up to you. Tech sector has given great returns, but also, it's more volatile also. In 2000, S&P fell 50%. NASDAQ was down 80%. So it cuts both ways. Volatility moves both ways. It's a much higher beta than the rest of the market, but I see no harm in splitting, based on what you may be comfortable with. If you are in tech industry, you understand tech better. Yeah, you could have a bigger portion on QQQ because you understand this industry. So that's my thought. And I remember when I started my journey in investing in US, I wasn't even looking at individual stocks because I had no time to read about individual stocks, and I was all ETFs, some S&P, some QQQ, some GLD. I guess I had 7 ETFs. I still remember 7 ETFs. Every week, I'll just go and pick. I had a set amount that I'll just distribute across those 7 ETFs in the proportion that I want to own those ETFs. I started investing in individual stocks very late. So, because you need time. I mean, if you are doing individual stocks, you better, know those stocks. So, and I didn't have time. So I was just on ETF route for many years. Why is S&P having such high valuation? Where is the real growth coming from? So we will look into a little bit of a growth, where the growth is coming from. Right now, like I said, so S&P is having high pricing. I don't know about what the real value is, but right now, I think it's all a lot of stuff on AI. A lot of stuff happening on AI side. Alfred says, don't forget DIA. So DIA, I have a different viewpoint. So DIA, basically Dow Jones Index ETF. I still can't wrap my head around the fact that the weightage in your Dow Jones is based on the stock price. What? That's how old the rule is. I don't know. But I can't wrap my head around the fact that a stock price which can be changed by splitting the stock without any changes business will change your weightage in the DIA. So I don't have invest in DIA because I just can't understand the logic why they're sticking with the logic of weightage based on individual stock price. I can understand you could do a weightage on market cap, or you go equal weightage, or maybe figure out, higher earning power, pick another ratio. Pick a ratio saying, it's, let's say it's free cash flow yield. Higher, better free cash flow yield will have a better weightage. I can understand that. But I can't wrap my head around the fact that if Apple is $100, it's got a weightage X. And if Apple split its stock and become $50 stock, the weightage changes. Why? There's no change in business, guys. So that's why I don't invest in DIA, but this is, I guess it is the oldest index and way more known outside of US. Dow Jones is, has got more recall power than, let's say, S&P 500. If you ask someone outside of US, they all about, okay, yeah, how is Dow Jones doing? That's the first question. US market, how is Dow Jones doing? But from my perspective, I think for me, it has lost its relevance just based on how the index is computed. Okay. That's nothing to say about what the composition or the companies are, but just that if you just focus on the index, doesn't make sense to me. Probably it does to many other people, and they still invest and the index is still there, but doesn't make sense to me. Okay, so looking at the contribution of stocks, this was an article from Bloomberg. So of course, I'm not going to go through the whole article, but in terms of on SPX, which stocks have contributed how much to the growth in SPX in first half of 2024? Right? I guess no surprises here. The best one is NVIDIA. So NVIDIA is up. So on the x-axis here, you'll see in terms of how much percent is the stock up, and over here you'll see how many points has that stock contributed to S&P. Okay. So NVIDIA is up almost 150%, even for 2024, right? It's still continuing its great run that it had in 2023. So what do we know? And it has contributed almost 200 plus points to S&P 500. Next is what? Microsoft, probably maybe up 25-30%, but because again, S&P is market cap weighted. So if it is a bigger stock, it'll have a bigger contribution, it'll have a bigger weightage. And if it is a smaller market cap stock, even though that stock might have gone up 50%, 100%, it will not have that much impact on S&P. Like Constellation Energy, that looks to be up maybe 60, 70%, say 70%. But the impact on SPY is not that much because it's a smaller cap stock. Now let's come to the other side of the house. We'll talk about Walgreens. Like it's down 50% plus for the year. Tesla is down, I don't know how much, now 20%? What's Tesla's? How much Tesla down for the year? 20.34%. Right? So Intel is down, looks to be 40%? 35%. So anyway, really highly constant. The rally, why such a high valuation? Look at the NVIDIA's valuation, right? If you're looking at a PE, it's 30 plus, and it has got a much bigger impact on S&P. So yeah, fewer stocks. You could say a lot of this is being driven by NVIDIA, and I won't debate that. Runners up are Constellation Energy that we talked about. This is then followed by GE, Eli Lilly, Micron. So Eli Lilly is enjoying the tailwinds from GLP-1, and Micron, I don't know how much is the impact of Micron after the recent results. I think Micron didn't do well. Walgreens, worst performer, shedding 52%. Right? It's a dividend pair, but if you just bought Walgreens because you love the dividend, man, you'll have to wait for maybe another 5-6 years of dividend just to recover from the fall that Walgreens had after its earnings announcement. I guess it fell down 25% after earnings announcement. In terms, okay, so I think we already talked about, NVIDIA contributed 218 points, Microsoft 64 points, Amazon, Meta, Apple, these are the top 5, right? So it looks to be, it's top heavy, and all concentrated on very few names: Microsoft, NVIDIA, Amazon, Meta, Apple. That's all. I see a link says what happened to the largest companies. What is the top 10 companies history? Okay. I think I have a chart which talks about little concentration. So hold on to these thoughts. Looking at this, another chart from Bloomberg in terms of a rally. So here they looked at, rallies from 1990 rally, then 2002 rally, 2009, 2020. That's the most recent one. And then this from October onwards, right? 2022, the most recent, the current bull run that we are still in. And this shows your ratio of basically equal weighted index relative to the market cap weighted index, which is current SPY. So when you say equal weighted, imagine if every company on the index, or those 500 companies, have an equal weight. You doesn't get more voting power just because you're bigger, right? Each company has the same voice. Versus the current one, wherein if you have a bigger market cap, you have a bigger impact, you have a bigger voice. Now, this green one really shows that, huge divergence. On others, we didn't have that much of a divergence. So this is again a point that, damn, the big companies in the market are driving all these results, while the rest of the companies, the undercurrent is not that bullish. That's again, hey, how concentrated could it be? Because looks like if you look at the returns of the equal weighted S&P, I guess we have a ETF for it, which is called, I guess, RSP. Someone fact check me. Yeah, equal weight ETF. It's up 4%. And SPY is up, what, 15%? 15%. Huge difference. It's like a 10% difference between these two. And yeah, understood that while, that we have been, again, this time it's the divergence is too much. So which means the bigger ones are having much larger contribution to the growth of S&P index than the rest, let's say 495 or 496 stocks. So some strategies will say that the rally looks overblown with rich valuation, with just a handful of high flyers pushing the markets, skyward. So what happens if those high flyers don't fly anymore? I think that's what everyone is concerned about. Who is gonna save us? If there are only 5 or 6 stocks, that is holding my house, and if that foundation, if there are only 6 pillars holding my house, and though there's a crack on those 6 pillars, it's gonna crumble. So because the other 494 or whatever, 493 are not doing much. So I think that's a concern. So we'll look at this again. I'm going to go back into a little bit history of market concentration. There is a great article from Michael Mauboussin, who also teaches at a Columbia Business School. So I guess like his articles are a CFA or a MBA finance investment like type of information. It's amazing knowledge, and his thinking is, very different. So I love reading his articles. So recently he had put out an article on stock market concentration. So of course, each article is like 50 pages plus. Sometimes some of them are like 100 pages. So it's like your one semester book. But I'll bring you the summary. So coming back to what we are seeing on S&P and historically what has happened is a strong first half has typically led to another solid run in the remaining 6 months. If you go back and look into the history, first half means second half will have a positive returns, right? So don't just sell all your stocks saying, oh, we already have 15%. Okay? S&P on an average of last 100 plus years has delivered 10%. So it's already up 15%. I think we are above average. Maybe it's going to go down, and let's sell. Let's not make that decision. So going back to the history, if the first 6 months have been strong, generally it ends up stronger, even in the last 6 months. But but we have a presidential election this year, so that could change, that could skew some of the results. We don't know what may happen. While the market is historically weaker in presidential election years. So if you look at the history of the market, whenever we have a the year in which we have elections in US, the first half is weaker. But this year, this is the second best performance in the presidential election year since 1928. Almost 100 years. Go back, look at 100 years of presidential year and look at how the markets have done. S&P market has done in first 6 months. This is the second best. Most of the time, it is actually weaker. So, did market, ran up too much too soon? Because on presidential years, it is actually, it's weak in first half. But this time, have we flipped? That we are, gone positive, and that to like 15% and may see a correction? Who knows? Every strategist will have their own opinion later on. So you can decide for yourself what you want to do it. But, I'm going to stay invested. I see a comment, irrational exuberance. Yeah, I've heard that word. I guess in AI specifically, I think there is irrational exuberance, but across the market, I still don't see it. Right? Look at the equal weighted S&P, it's up only 4%. That's not irrational exuberance. I would have been more concerned about overall market, fully market, all type of sectors being hot. If as RSP was also, up 15%. So yeah, it is being driven by some of the handful companies, and majority of those companies are up how much ever they are. Like NVIDIA is up 150%. Amazon just crossed, $2 trillion club. Microsoft is up whatever 35-40%. And these are like, we're talking about $3 trillion companies, right? These are not $100 billion, $200 billion companies. These are $3 trillion companies. And if all the tailwind that they have is from AI, maybe there is some irrational exuberance in AI. Anyway, so let's talk about market concentration, getting back to the market concentration stuff. I don't think we need to talk about what is concentration. I guess now we've already discussed. In 2023, we had Mag 7, which were, contributed almost 50-60% returns. Sorry, 20. Let me see. In the decade ended 2023, US market okay. The weightage of top 10 doubled from 14% to 27% in the decade that ended in 2023. So that means limited number of stocks played a larger role. That's what we've been talking about. Magnificent Seven were responsible for more than one half of S&P 500 gain. 13%, Microsoft contributed to 13%, 12%, 11%. We add all of this up, it's more than 50% of the gain in S&P came from these 7 stocks. And this is why, because the market is concentrated, it is becoming way more difficult for stock pickers, hedge fund managers, active managers to beat the market. Imagine you miss out on those top 3 stocks. There is hell no way you can beat the market. It's almost impossible. And in 2024, if you did not have NVIDIA in your portfolio, good luck. You can talk all about, I don't like the valuation and everything else, but it's very difficult to beat the market if you don't have these. In in this year, it's only like top two, like one stock, NVIDIA. NVIDIA has contributed to 1/3 of the S&P gain this year. Just one stock. And we're talking about one stock out of what, 3,000 plus stocks in the market? You know how difficult job it is to make sure that you have that, if you are an active manager, if to make sure that you have had that one stock in your portfolio. That's why it is in a market where the concentration is higher, it is very difficult for active managers will generally underperform. When the concentration becomes lower, that's when the active managers will have a better chance of beating the markets. Anyway, so looks like in 2024, it's even more concentrated. It's all about NVIDIA right now. Right? And this was when at the end of May 31st, when the NVIDIA was up 120%. If you look at now, NVIDIA is up 150%. So the 30% since then. So probably it has gone, concentration has gone even worse. But is it a new phenomenon? We are worried about concentration right now. Markets are worried about concentration. There have been articles and articles over, hey, there's a handful of stocks are driving it. But is this anything new? So this is a chart from 1950 till 2023. Top 10. What's the concentration? Top 3. What's the, how much have they constitute of the overall S&P 500? And this is top 1. Right? So I think the highest concentration we had in 1960s, when top 10 were almost equal to 30% in 1963. And now we are getting closer to that. We are now 27% of S&P 500. The lowest concentration was 12% in 1993. Going further back, I don't know that chart. In 1930s, we had a similar situation where the top 10 were equal to 38%. Right? So this is nothing new. Markets have concentrated, have been in this concentration before also. But what is new is the pace at which this concentration has increased. So if we can see this, let's say draw it right here, 2013. Right? This will be what, 15%? From 15% to 27%, the pace at which this concentration has increased is probably the fastest, and that is causing us concern because we haven't seen anything like this before, in which smaller number of companies make such a huge impact in the markets. Other one, companies in the top 3 slots from 1950 to 2023. Oh, this was an eye-opener. So at the end of every year, you figure out which is the top company from market cap perspective. And do it every year from 1950. So that's almost 75 years, 73 years of data. There have been only 7 companies in top 1. Can you imagine? Only 7 companies that have occupied the slot as or the crown of the most valued company in US. Just 7 companies in last 73 years. And top 3, only 17. And out of 28,000 companies that have traded in US stock market. That really blew my mind in terms of, how very few companies have largely dominated the US stock market over the last 73 years. So this is the chart. Looks like AT&T and IBM had spent so far, they've been the winners in terms of how many years they were number one uh, in terms of market cap in US. I see a lot of light blues over here, lot many over here. Looks like GM was the best, the highest market cap company in mid 1950s. Right? DuPont wasn't number one; it was number two, number three. Exxon was number one in 2005, 6, 7, 8, 9, 10. 5 years, Exxon was the largest market cap company in US. IBM held that slot for many years. Wow, Kodak was number three sometimes. So anyway, in more recent history, it's been Apple that has demonstrated, AT&T, IBM-like strength, had held the slot for the most valuable company for many years. Google has never been the most valuable company. At the end of so this stats is at the end of a year, right? In between the year, yeah, companies go up and down. Microsoft has now been the most valuable company. Nvidia was the most valuable company for a day. Well, let's see whether where does Nvidia end up at the end of a year. So this is end of a year. Only this total, if you total this up, there are only 17 companies that have been in top 3 slots. Right? And again, if you are an individual stock picker, out of 28,000 companies, there are only 17 companies that have occupied the top 3 slots. It's not easy to find these 17 companies. But if you pick up the ETF, the bigger you will always have those biggest companies in your portfolio. Now let's look at the concentration outside US. In 2023, US is far below. There are other markets, and these are all developed markets that we are looking at. Of course, I think China and India, we call them as developing markets. But 20 is now suddenly looking at this chart, US out here, 27%, top 10, doesn't look that bad. Does it? Switzerland, like 65%. France, 60%, 55%. Yeah. On an average, and this is not just this year, you go back and look at 47 equity markets from 1989 to 2011. On an average, it is like 48%. So I was a lot more concerned about the concentration, but looks like, this is a common phenomenon. Again, because we've been investing in, or at least I've been investing in US only, even after that, I wasn't even active in 2013. So it's been just a decade closer to, this pace probably has confounded me. So now the bigger question is it also creating more value, right? Not just the market cap. Market cap is what the pricing is, but value, right? Has these businesses, the big businesses, have they generated more economic value? But in a long run, that's what survives. Market price will go up and down depending on, if you hit a lottery today, you'll probably be willing to pay, 150% of a house, which is in the market. Doesn't really mean the house is worth 150%. So not even talking, but the question is, have these companies created value? Because if they have not created value, then I would say, oh gosh, everything is being driven by the exuberance, which is fine. That's a momentum investing. You could be in it, enjoy while the ride is going on. Or, if it has not created, or if it has created a value, then maybe, I don't have to be afraid of the fact that these big companies are enjoying these big gains. So let's look at the value creation, right? So the whole study done from 2014 onwards, because that's what we want to really look at, because the pace at which it increased is like 2014 onwards, right? So question is, has these companies created equivalent amount of value, that the market is rewarding them for with a higher market cap? So look at economic profit as your return on invested capital minus your cost of capital, right? This is what your sale is, returns minus the cost, and then how much money you are reinvesting in the business, right? And this was kind of an eye-opener for me. Looking at 2023, right? They were top 10 stocks were responsible for 25% of market capitalization. That's what the concentration is. But it earned almost 70% of the economic profit. 70% of the economic profits created by 500 companies in S&P 500. The profits, economic profits, not the accounting profits, but the economic profits, 70% is coming from these top 10 companies. Then I say, guys, they deserve this market cap, which they currently have it. Then this concentration, my perspective is, then this concentration is actually backed by real value creation. These are some great businesses that generate a lot of cash, that create a lot of value, that have a much bigger return on invested capital, and hence market is rewarding them by pushing up its prices. Now, this is like top 10, right? Not just Nvidia, or maybe Nvidia could be overvalued. Might say, oh, it is actually market is rewarding it more than the amount of economic value it is creating. But this is overall looking at top 10, where you have a company as Apple, $100 billion of free cash flow. Right? Nvidia's revenue in 2023 was $100 billion. And a company like Apple has got a free cash flow of $100 billion. So now if I look at here, 2021, I hope I had the access to that this study was done sooner. 2021 was clearly the economic profit was maybe 30%. I don't know what the concentration of 2021 was of top 10. Maybe 25%, because that's where it peaks. But again, this doesn't look to me the fact that I should be worried about this concentration in the market. This is actually driven by the amount of a value or the kind of businesses that are occupying the top 10 slots, right? These are not the businesses like steel business or the transportation or energy business, which are hugely capital intensive. Their returns are lower. These businesses have a huge return on invested capital. Sure.
Did you see my this other guy I follow? He said the Magnificent Seven account for over 30% of the S&P 500.
Yeah, right. Right now we're looking at 27%. Maybe by end of 2023, it was 27%. Now it may be 30%. But all I'm saying is those, again, this is not for number for 7, but out of those 10 companies, they're also responsible for 70% of the profits generated by all 500 companies. So I guess they deserve it. Another chart. Now the bigger is becoming better, right? So generally what happens, the bigger the companies become, when I say old economy companies, 1980s, 1970s, you slow down, right? Your returns start to fall off. right? Because the law of large numbers. You're already so big. How much bigger can you grow? How much more returns can you squeeze in because your base is already bigger? Not in the last, I would say, 10 years. So this shows the difference between the return on invested capital of large caps and the small cap companies. Right? Now, looking at early 1990s, the difference wasn't that great. Now, starting from 2009 onwards, right, as you can see, this gap has become bigger, right? On an average, you see it widening from this time onward. That means the bigger companies, large cap companies, are able to. This gap is not the market cap gap. This gap is how much you can generate on your invested capital. If I'm able to generate 25-30% return on invested capital, that's a great business. And that gap has increased, means the bigger have become more efficient and in running the business, have been able to capture more market shares and hence have been able to generate much bigger return on capital as compared to the small ones. Yeah, you could say it is like becoming monopolistic and the market or is being cornered by a much bigger, just a handful of bigger companies. Maybe they are, and that's why I think the smaller companies are not able to compete against them. On aggregate, the difference was like large cap were only 0.8% higher. And this is not top 10, but it looks like the overall large cap companies. Now, from 2000 onwards, it is like 4.1% difference. So traditionally, active managers focus on small cap companies because then you study the companies when they're in their infancy, this become much bigger and help as a manager. If you found those hidden gems in their infancy, that helps you. Last 20 years, the large caps have been, the business itself has been performing much better than the small caps, right? So tough for small caps to beat the large caps. Now we're looking at S&P 500 returns in the top 10 concentration. So they looked at the various decades, 1950 to 60, 1960 to all the way 1990. So this tells us that when the concentration is increasing, right, when the bigger companies, when the fewer companies account for bigger portion of the S&P 500, markets actually have delivered much higher returns. Now, when the concentration is falling, right, say this is from 1960 all the way to 1994, right? Let's go back and look at the concentration, 1960s to 1994. The concentration has been going down. The market returns is like 10% on average returns. Again, when the concentration starts to increase, so essentially the study shows when the concentration is increasing or during that period, the market returns much better than the periods when the concentration is decreasing. Could be the case of, bigger becoming better, bigger are stronger, and if they have a much bigger weightage, and hence the market performs better. But something to think about. Right. Now, I think the last one was how has investing in top companies have fared. So in the study, they constitute a separate index looking at just top market company, number one market cap, number two, number three. And then they said how it has performed against the total stock return, of the overall index. So they created an index of total stock return relative to S&P for each of the three largest stocks starting at the end of 1950. So goes almost 73 years. Index start at 100. then you see how that number one company has performed, right? The top stock has historically been a bad investment. Top has been a bad investment historically. The number two and number three have fared much better. Right? However, in the last 10 years, is the biggest companies have delivered the best return. The number one has given like almost 3.5 times more than the overall S&P 500 has done. So a focus on the strong fundamental results for these companies, new tech like artificial intelligence, etc., has disproportionately benefited large firms. So that's why all these AI, etc., the bigger ones will be, will benefit more. Owning the stock of the largest company has been a poor investment relative to the market overall until about a decade ago. I don't know what's going to happen in the next decade. So that's anybody's guess. But I just wanted to share this study with you. I was a lot of skeptical about market concentration, little more concerned about it. But I guess some of these companies, they do deserve that valuation, not about individual companies, but as a group of top 10. Damn, they are generating a lot more returns, man. So why not? So that's a primer on stock market concentration. Let me see some other comments. Aditya say, maybe this is just evidence that it's a technology. Internet is making world a more polarized and unequal place. As far as business returns are concerned, that looks to be the case.
Yeah. And that's where part of me is almost inclined to think that going forward, I mean, the index is a wonderful, wonderful instrument that just going forward, like almost allocating a small percentage of the portfolio in the top 5 might not be a stupid strategy. It might be a worthwhile bet because the world is just going to be a more polarized place. What do you think?
Yeah, I mean, if you take S&P, you're already getting that percentage anyway, because it is market cap weighted. So if you take S&P, you get like 30% of your investment in S&P is going to the top 10 companies. This is why even though I do individual stocks, my biggest holding is on S&P because I don't know 20 years down the line who will be number one.
Right.
That's a problem that I have today. Whatever Apple, Microsoft is number one, will they be number one 20 years later? I don't know. But if I own S&P, I know whichever company is number one, it will have a much bigger impact on my portfolio because it has the most impact on S&P.
And this is true for irrespective if you go invest in the ETF or a mutual fund.
The mutual fund it will depend on what that mutual fund is tracking and how that mutual fund is constructed. S&P 500 is market cap weighted, right? So if it's a Microsoft is number one, that will have a higher weightage in terms of impact on S&P performance. Let's say Microsoft moves up 5%. And another company, smaller market cap, moves up 5%. The smaller company is not going to impact S&P that much. Like we saw, like Constellation Software or Constellation Energy is up 70%, but has contributed only 2 or 3 points to S&P. But the bigger companies have contributed much more. So you have to understand how that mutual fund is constructed. If it is following, mimicking SPX or S&P, then it will do the same thing. But if it is mimicking something else, then it's anybody's game. Like Dow Jones Index, they have a different way of how they want to build the index. It's not based on that the biggest company has the biggest impact. It is based on the biggest share price has got the biggest impact, which I can't make sense of it, but I guess they can.
Yeah.
So,
Yeah.
so you have to understand how that mutual fund or index is created.
And to just linger on that point for a few more seconds. So if you were to invest, let's say for ease of calculation, $100 in the market, and the market's grown by, again, ease of calculation, 10%. So your net investment's about 110. Now, majority of those gains came from Apple. So, or Nvidia's. So if you had held the top 5 instead, so you'd invested whatever 20 each in the top 5 instead. The growth profile would be very different, or are you saying it won't be very different because the index is market cap weighted?
So I don't know. I mean, I've not seen any study which say picks up just the top 5. But if you're saying top 5, then I'm assuming that you're looking at the end of a year and see, okay, which are the top 5, right? Tesla has fallen off from, let's say if Tesla goes down another 10, 15%, it will probably fall off from top 10. So it means I'm assuming that if you are saying the top 5, you're looking at the end of a year and rebalancing your portfolio, saying, okay, now to pick which new top 5 are there.
Yeah.
So I've not seen any study, but then in that case, you have to account for the taxes, because if you sell something, those have appreciated, that's going to be a big impact and drag on your portfolio.
Right.
If you just held S&P, you're not selling it, and it's not a mutual fund that you buy hit by taxes. Even if mutual fund do some rebalancing there, if you don't, as long as you don't sell, you don't get hit by any taxes on S&P. So you have to account for that. Let's say you had Microsoft, right? Going back to that chart which shows how the company, let's say here, Microsoft was number 1, number 2, number 3 so many years. Let's say in 2000 whatever, 11, 12, it didn't appear. Maybe let's say if it is lower than number 5, if you sell your Microsoft now, I don't know how much of a capital gain you had, and you then give that 30% of that to government, and then you reinvest the rest of it. I think it may end up like worse because you're reinvesting much less capital going forward. So that's another thing that you have to account for.
Yeah. Thank you.
All right, India won. So I think after about 14, 15 years, going back to the sports, I saw a message from Ravi. So thank you for keeping us updated. Good one. I'm gonna get the stories of who played, etc., from my wife. Any thoughts on rut rebalancing on Friday? I don't know who's going in and going out. So rut is basically 2,000 companies on S&P 500. So I own ETF IWM, right, which is which mimics RUT or Russell 2000. And I'm having now like different thoughts around, the reason why I own is again the same stuff. That smaller companies, if you capture them early, and become much bigger companies, will have much higher impact on your portfolio. This got me thinking, and the fact that it's an ETF which always invest in smaller cap, not always investment. Basically, it's got 2,000. So it has also got a lot of small cap companies. Now, my worry on RUT or IWM is, and I'm thinking, rethinking my decision. Should I stop or, move some from IWM to S&P, etc.? Is if the bigger companies are generating more economic profit, bigger companies are having more return on invested capital, and the gap is widening, then maybe I should move some money from IWM to SPY, because let's say there's a great company which is a small cap and is doing great, but the moment it becomes, a little bigger company, it gets into S&P 500. It may not be, in RUD or in IWM anymore. So does that mean, that the moment a company becomes better and starts to have much bigger impact, starts to grow market share better, because it looks like the large companies have done it over the last 10 years, have done much better from business perspective, it actually goes out from IWM. So then my investing thesis on IWM will only be the rate cuts. So I'm still thinking through it. I don't know, anyone else have a viewpoint on it? Because the moment company become bigger means, and the company will become bigger if they are a great business, if they're a good business. So then it's no longer in RUT. So then what the heck I would own RUT, which is like, yeah, I'm growing it, and there's an uncertainty. The moment you become a great business, it's outside of a RUT. So I'm debating that thought process, especially once I went through this study, and maybe I should put more on larger cap. I mean, any thoughts you have to share? I want to honestly, am I just missing something?
Yeah, no, I want to share some observations. So I used to make apps in the Apple Store, about 5 in there right now. And time and time again, I saw, all these companies, Apples, Amazons, etc., were just treating the smaller, and so this is where I'm saying the smaller, they have this ecosystem where the smaller companies or applications, they see what's working best, and then they start replicating it, and it gets killed off, right? And it becomes harder for the smaller guy to compete. And they could be selling socks on Amazon or like a sleeping app on the App Store. And these guys end up integrating it. Same story with Slack. I see Microsoft overnight integrated the whole channel and all of that and bundled it, Teams with the MS Office package. And I mean, how? And I think from the larger companies' perspective, they've got teams and teams of lawyers. They can just deploy.
Yep.
So rather than invest billions in R&D, they can get away investing millions in a legal team and fight these guys off, and or buy them out. So and that kind of tends to explain why the bigger is getting bigger and the smaller are having a harder time to fight back.
Yeah, I completely agree. I mean, that's the whole antitrust case against Amazon is, right? Guys, you're a marketplace, plus you are a retailer also. They see any a product becoming successful because they have all the information, they have all the analytics. They'll come up with their, Amazon's own brand. I mean, they discontinued now a lot of stuff on Amazon Basics because that was a huge antitrust concern. But that's I think, concern across all the big companies is. I mean, look, Zuck is known for copying, right? So it says you got Zuck means Zuckerberg has copied your feature into Facebook, right? Snap came up with, and what Zuck call it, what, Reels or something, whatever.
Yeah, exactly. So I interviewed at Facebook at one point, and they ask you that what's your biggest and best idea, and that's a critical point that decides if you get recruited or not, and they make you sign a paper saying that we can use this idea and you can't sue us for it.
So, yeah. But I guess maybe that's the kind of businesses that we have, the bigger ones, and they can spend, I mean, they have a war chest to spend a lot of money, either fighting the government or if they have to invest, that too as well. So Anyway, so I was just thinking, I think I'll share because this is our first meeting at the end of a month. I mean, technically it's not end of a month, but from a market perspective, it is. A Saturday, Sunday market is not open. So I looked at my portfolio. I'll share what I own. I think it's still IWM is still I guess in top 20 in position in my portfolio. So I was thinking about it. Maybe I should rotate. Anyway, so that's around the stock market concentration. Let me see any other questions. Sam says, Kramer said maybe December 2023 buy Google and Amazon over Microsoft and Apple. I don't follow what Kramer says. I have
He
to
said,
my
don't
own
buy,
opinion.
don't buy Apple or Microsoft, because he was suggesting Amazon and the other two, Amazon and Google, because they were in that pole position.
But
Sorry.
but Apple has done, I mean, or at least this week, there's some good news, good story. This was like after their whole Apple AI, and I think now there's some good story coming out from China. Looks like the shipments is up what 40% of in China. That's at least what I heard, maybe on Bloomberg or somewhere. So we don't know. Apple's still up like 13% for the year. I've heard about hypothesis before about Russell makes sense, the index of pool of mediocre. Exactly. That's what I'm thinking. And right now, now the thesis becomes, gosh, if the rate cuts happen, they will have a much bigger impact. If the cheaper loans have a much bigger impact on small businesses than on large businesses, because large ones, they can generate cash from the business. They are not so much dependent on availability of cheap loans, right? So, but that's not a thesis that I want to live with, saying, that the companies will do good if they can get a cheap loan. So I'm debating, maybe I should rotate. Alfred says Monday is the beginning of new quarter, so a lot of mutual funds will be buying. Any thoughts on this? So if they are buying, probably they may be selling also. So they will be do some rotation. I know XLF probably already rebalanced, but again, I don't invest. And this will happen every quarter. The mutual funds will rotate. And if they're rebalancing based on whatever index that they have been following, so they will buy some and they will sell some. So I guess over a long period, it just probably will balance it out. Do you still hold Axon? Remember we talked? Yeah, I mean, I did a whole deep dive on Axon, and I had some position in Axon. I guess 2021, 22. I don't hold an Axon anymore in my portfolio. The reason is, my thesis was, and again, I mean, it's a great company, but I want to see them do better on operating margins. I didn't look at it Axon for last year or so. I mean, their cloud stuff, they are coming up with their cloud story, and that is what is most exciting. But I don't think that, or maybe when last I looked at it, it hasn't really translated into better operating margins. So I remember dealing in Axon in that time also, it was around $250. Yeah, maybe around 250s, 220s. I don't know, maybe somewhere here. No, I think it was somewhere 200 or some. I held over there. But let's see the financials. Has it improved its margins? How much is their operating margins now? 9%, 7%, 8%. So it looks like, again, my thesis would be, and yeah, of course, they have a monopoly on their teasers, which where they started, and now then they have their cloud. Then they have their whatever that case. I forgot. I mean, we reviewed this company, and they have kind of a monopoly, right? So from that perspective, it's a great company. I'm just waiting to see the impact of their cloud. onto their margins. I don't think this. I mean, they will continue to own this space. I just want to see if they can have a better margins. Otherwise, maybe I'll invest in some other companies on better other stocks where I can see better margins. Nothing against Exxon. It's a great company. And their products are great. And like you said, you use it in the police department. This is the most used software across, I think, law enforcement across US. And now they're expanding in abroad also. But not the whole, but I guess the majority of their growth story in the stock is based on their SaaS offering, which hasn't yet percolated into the margins. So that's what I don't hold any Exxon right now. Hopefully that answers the question. Let's move on. But if I held Exxon, would I be selling it right now? Probably not. Because it earns. It earns, but it's worth. A quick look on crypto. So we are seeing some weaknesses. Crypto. Bitcoin is down to 60K. This was when I had taken this a few hours ago. Yeah, still 60K. You never know. On crypto, you never know. In a few hours, things could change. So it is always good to go back and say, where is now? It's trading. So anyway, so what's causing this weakness? There are a few factors. One is Germany was selling like $3 billion worth of Bitcoin. Then there was a hack that had happened. Like OGs will remember. I wasn't active at that time. In Mt. Gox, that was probably the first exchange out of Japan, got hacked, and hundreds of thousands of Bitcoins were stolen. Eventually now, the prosecutors and the trustees, whoever, like equivalent of the trustee, have now figured out who will owe what money and start the disbursement of the money. So that means there will be another $9 billion worth of Bitcoins will be sold or given to the rightful owners who may now sell it. I don't know are they going to give cash? Then they have to sell it. I don't know what's the modality is, but there is a selling pressure coming from there. US government also sold some Bitcoins. Then the ETFs had outflows for 2 consecutive weeks. So a lot of retail selling has been happening. I think that's what is causing this weakness in Bitcoin. Looking at the ETFs, while we are seeing 2 weeks of outflow, but still BlackRock has got 303,000 Bitcoins and Grayscale is the number 2 one. And I guess these 4 or 5 will remain. Others will probably, get subsumed under these 4 or 5. Looks like the ETF market is going to capture by BlackRock, Grayscale, Fidelity, ARK, and Bitwise. So let's quickly on crypto, unless there is some question around it. Okay, let's move on. Stocks which I bought or sold this week, none. So this is first session after end of a month. Yeah, so IWM is like 11 on my portfolio. So this was where end of May, end of June, not much change. I guess out of all 15, the leaderboard is still the same. It's the same 15 companies that were, the top 10, same as occupied in June. This is cash, so not a company. Otherwise, S&P is my top position. Apple, because of after this whole Apple AI, now it is on number 2. Then Mercado Libre, Meta, Microsoft, Google, ACHT, QQQs, ASML, IWM, Nvidia, Amazon, Berkshire, Shopify. That rounds up top 15. Any questions? I'll sip some water.
Yeah, actually, I'd like to ask about your investment thesis for Shopify.
So Shopify, I became interested in Shopify 2019. That's when my thesis at that point of a time was, if you are a bigger company and if you want to build your own storefront, either you go and create a shop in Amazon, right? You can use Amazon to create your own shop. But if I'm a bigger brand, then I don't want, Amazon is my competitor also, right? The topic that we just discussed, right? Or when I say bigger brand, means it's not like the Nikes of the world, because they can afford to do everything on their own. But you are a like medium business segment, which you're growing your brand, right? Small and medium, but you're growing your brand. So, or you spend, a lot of dollar, time, energy in hiring good engineers, developers, and build a whole e-commerce offering. Shopify provides you a way, it's probably a way to come out of Amazon and build your own storefront, and you don't show it to Amazon what you're selling, and you don't have to, invest in infrastructure, because as a retailer, my core business is to sell goods. So if I don't have to spend money on and time, energy on building my IT team, that's good for me. So that was my thesis on looking at Shopify in 2019. I think that's the first time when I looked at Shopify as a company, saying it gives me way out of Amazon. I can get out of an Amazon prison and still be active in e-commerce as a small or medium business segment. And that was my thesis. So, and I think that thesis, I still have that thesis, because e-commerce will continue to grow. We will see, companies coming and selling online, more and more companies, right? Even if we look at now, the retail, the overall e-commerce retail in US, I mean, still majority of the retail happens in physical stores, right? Not in e-commerce. And look at the rest of the world, there's a huge opportunity is still there. So, and I think that thesis is still there. But I didn't invest into Shopify. I think, let me go back and see, when did I first invested in Shopify? And then I started selling options against it. So I think for me, it is turned out, I mean, still a good investment. So I'm willing to hold it unless there is any change in thesis. But that was my thesis on Shopify. So why did the Shopify stock fall in last couple of years? Sometimes the stock gets ahead of its business. So 2021, let's look at Shopify. Everything got overvalued. So stock price is a different stuff, right? So I'm looking at first time I think first time I bought was, I had a brief stint in 2019. Put got assigned, call got assigned. Then I picked up only in 2022. So yeah, my association with Shopify has not been very long. It's been only 2.5 years. So, but it's been a great investment since then. So yeah, it would have fallen because 2021, all the e-commerce companies were bid up extremely high. The stock ran up much ahead of what the business maybe was worth. And if in 2021, I was looking at the companies and the businesses the way I look today, I would have probably sold some of my Shopify. I mean, I didn't even have anything in 2021. I picked up in 2022 May. I started building positions in Shopify. But that's the case. A lot of e-commerce, a lot of tech companies had the similar fate from 2021. Look at companies like Roku, right? Online ad, what, 450 plus, now sitting at $50. So a lot of companies went through this whole cleansing of valuation. I see another comment. No Broadcom on 715 or CMG, both stocks split. Yeah, I mean, I'm cautious on adding more tickers to my portfolio because you can only track so much. So once an opening comes on my, and again, there are so many great companies. So it's always a choice between what should I pick up, what I should not pick up. And of course, I have my own limited bandwidth of how many companies, individual companies can I track. Then third thing is I want to look at and say, if I want to, rather than distributing capital across 6 companies or 10 companies, picking 20 shares of each, I want to pick up at least 100 shares so that I can then start selling covered calls and do that stuff, right? So yeah, I don't have Broadcom in my portfolio. I don't have CMG in my portfolio. Yeah. Cool. Okay. All right. So let's move on. Again, I'll bring you this portfolio pizza again at the end of next month. So just a glimpse. Again, this is not a recommendation. Don't go and buy Shopify now because I talked about it. But I want to be transparent because we do talk about stocks. And I tell you, I like this. And you can make your own judgment. We have seen many folks coming and pumping their bags on CNBC, right? So if you see me talking about Mercado Libre, you can determine maybe he's just pumping his bags, right? Or maybe it is actually a good company, who knows? But I want to give you that information so that you can make your own decision. Okay? All right, so let's look at some companies. Fisker filed for bankruptcy. Right? It's the end of road for them. It was hailed as a Tesla challenger some part of a time, and it came to public via SPAC. Now the whole SPAC mania is, unraveling over the last 2 years. Which SPAC company is actually successful? As I recall, Virgin Atlantic is bad. I mean, I'm thinking about 2021, some of these SPAC, the companies that came to public market through SPAC. So this is Virgin Atlantic. Wow. They must have reverse split it. It was never $1,000 stock. Did they have a reverse split or something? Or am I completely missing something out?
Was ARM successful?
SPCE reverse split. Oh, they had a reverse split. Because I remember one of my friends talking about Virgin Atlantic, and he had a friend who knew someone in the board or maybe top level of Virgin Atlantic. It was $26. And he asked me, you should take this. I'm like, hey, if you want to do it, at least sell a put. Give yourself a room for error. I don't know what he did, but I am glad I stayed away with that. I guess, yeah, a lot of these SPAC companies were, and I mean, we talked about those SPAC, right? How the incentives were completely misaligned. The SPAC sponsors and the investors' incentives misaligned. So I always had a very skeptical view, but that doesn't mean I didn't try to gamble some of the money and lost some, which is okay. It was a gamble. DKNG looks okay. That's a DraftKings. I think DraftKings has now recovered because of, I mean, They had some nice recovery. Yeah, DKNG is a nice recovery. I think I owned DKNG about 45 or somewhere, and then I sold it out. I had only very small position. When I was cleaning up my portfolio, I sold DKNG, maybe 20 or something. Took a little bit of a loss. ARM came very recently. So I'm talking about the SPAC, which ARM didn't come via SPAC. ARM came through a normal IPO route. And that too this year. So I'm talking about the companies which came IPO to the market via SPAC process in 2021, because that was a height of SPAC, right? Chamath Palihapitiya was a SPAC king. He had his whatever helps. What is IH? I even forgot what's the acronym was. A, B, C, D. He had tons of those SPAC companies. Could you please explain a SPAC company? So I'll give you maybe 2 minutes on SPAC company, because I had a whole deck that I went through in 2021 talking about how the incentives are misaligned. So be careful. So there are a few ways in which company can come to public markets. What is a normal IPO process that we generally see, which is happening, in which company will file S1 document. You and I, we have access to S1 document. We'll review it like we did for hims and hers, or Reddit, or any other company, and then we make a decision. So that's called a traditional IPO. Then there's another in which there's something called a direct listing, in which company will file. And that traditional IPO, the way the stock is sold is that the company doesn't sell to us. The company will sell its shares to Wall Street bankers, like Goldman Sachs, whoever is a lead, what do you call, arranger? No, there is some word, right? I forgot. Lead banker on that IPO. So they will buy the stock from the company. Let's say the IPO price is $35. The banker will buy $35. Then the banker will sell to their customers and family, friends, and whatever. And when the company gets listed and start trading, then the bankers will, sell the company to the retail when you want to buy, right? So that's a traditional IPO. Direct listing is when the company is directly listed on exchange. They don't go through bankers. Okay. So, and I guess Slack came public via direct listing. Was DraftKings direct listing, or was DraftKings SPAC? I am not aware. Maybe it was SPAC or was it direct listing? But I knew that Slack came via direct listing. There are a few other companies. Then the third one, and in both in IPO and in a direct listing, you have to have those S1 documents and everything else filed with SEC. Third, another route is a SPAC, is called Special Purpose Acquisition Company. And this is nothing new. That this route has existed for decades, but it was grossly misused in 2021. In this company, what happens is there is a shell company which goes and lists itself on public. And because if you have to list yourself on public exchange, you have to file S1 document. But I'm just a shell company. I don't have any products. So my S1 is pretty clean, which says that, hey, I'm a shell company. My business will be to go and look and acquire another company. And I plan to do that generally, SPAC will do it in next 24 months. Right? Pretty clean, nothing in the SPAC. Now that company is already now listed in the stock market, and generally they will trade at $10. That used to be the standard. Now, if I'm a Virgin Galactic or I'm Fisker, if I listed my S1, in S1 you have restrictions. You can't project your revenues for future because those who knows whether the future will be there or not. But if you're going via SPAC, in this case of a SPAC, what happens is that the company which is already public will acquire Fisker or Nikola or Virgin Galactic or Clover Health. And then the Clover Health or the Virgin Galactic start trading on stock exchanges. So that's a SPAC route. When you come via SPAC route, you're not filing new S1, right? So you do file a document in which, and that document has got more relaxation because it's not a S1 document. You can give any rosy picture you want to. Company like Fisker, Lucid Motors, they told like we will have $5 billion worth of sale in 5 years. Right? Lucid can't even have done even 10% of the sales what they had committed. So a lot of unprofitable companies, a lot of because there was mania in 2021, they find it easier way to come to public via SPAC. And more importantly, the sponsor of a SPAC had you get whatever 25,000 or some 25%, and I forgot. You get paid just for bringing a company to public. Right? So the complete misalignment, because as a retail investor, if I buy a stock, the sponsor has already made its money because they brought a company to public. Whether the public company performs or not, he already made his money. He or she, right? So that's what the SPAC route was. So we saw a lot of these companies who came public via SPAC, and of course are now lost 99% of its values. Okay, so DKNG came via Diamond Eagle Corporation. Yeah, but few of the companies that actually did better. Okay, so there is a stock analysis. Thank you. Let's see how these. Oh, it doesn't. Oh, it doesn't have a data for. Yeah, 2021. So look at 2021. You see, there were stats were like the number of companies that came public via 2021. The stats were like off the charts. I mean, you'll have to go back and look into see. So by 2020 and 2021, that was like a boom time for SPACs. Now, majority of this, I would say, majority of these companies are probably either become bankrupt or the shares have lost tons and tons of value. So Fisker came via SPAC, valued at $2.9 billion, and it raised $1 billion. So what, as an investor, the lessons that we can learn is pay close attention to the relationship among folks in leadership team. See, if you are investing, you should know who is in the management team. So that's why when I look at a stock analysis, I look at the management, right? See who is a CEO, who is a CFO, how much do they own. In this case, the CFO, CEO, COO is a spouse of CEO. And then if you really dig and look into Dr. Geeta Gupta's responsibility, she's the CFO, she's COO, she's responsible for investor relations, she's responsible for business development. There's like 7-10 responsibilities. That should have been a red flag anyway. It's like a family business, man. Okay. Number 2, outsourcing of manufacturing. So Fisker's business model was, we're not going to manufacture the car. It's too capital intensive, right? Of course, to build a plant, you need billions and billions of dollars. So they say we're going to outsource the manufacturing to a company which is called Magna Auto. It's a big car manufacturer, just like Foxconn manufacture phones for iPhone. Magna manufactures vehicles for a lot of automobile companies. It actually started as a parts manufacturer, graduated into up the value chain into vehicle manufacturers, like contract manufacturers for vehicles. So they use Magna, but if you don't have a scale, it becomes super expensive. Right? So that's number 2 lesson. $1 billion is not enough. They raised $1 billion. It would have been much better if the company had not gone private or maybe raised money through some private equity. Bending metal is hard and needs a lot of money. So that's a lesson from Fisker. Right? Great design. I think the CEO of Fisker is a great designer, but can't make the cars. So that's Fisker. State of the EV stocks. And I think a lot of these came via SPACs. Fisker, Lordstown is bankrupt. I don't remember Proterra or whatever. Mullen, I remember, Mullen Automotive. is 99%. Faraday Futures, oh, this we recently recalled because of this whole meme mania. Canoe, I think this was also SPAC. Workhorse, SPAC. Nikola, SPAC. Helion, King was SPAC. Lucid was SPAC. Rivian is down 94%, but Rivian is doing much better, at least this week. Neo is not a SPAC, but it's down 93%. Xpeng down 90%. Tesla is down 55% from its all-time highs. So, right on the EVs. I see a question. Are you concerned at all about possible passive investing bubble? Yeah, this is something that is being talked about, especially, I guess, David Einhorn. He ranted, was it Einhorn or one of the other hedge fund managers? Maybe I'm confusing someone else. He's ranted around the whole bubble in passive investing. It is because we are mindlessly investing into companies, whether those companies are without knowing the business of that company. So that's what passive investing is. But I guess, okay. On passive investing, Michael Burry told all theaters are overcrowded. The only way anyone can get out is by trampling each other. And still the door is only so big. The longer it goes on, the worse the crash will be. How long that is and just how big passive will get in meantime is anyone's guess. But if, and again, when I say passive means, let's look at an example of SPY. Let's say we have a correction because the companies that we've invested in, or the bigger companies, the business has not performed as much as their stock price has appreciated. Currently, that's not the case. Then yes, those stocks will fall off hard. But then the other businesses, market will reward those active investors' businesses, which are businesses good, but the stock was not appreciated, and those will become bigger. And if those become bigger, S&P 500 will have more impact from those new businesses that have now become bigger. So I guess in the long term, during the cleansings, there will be always some company which is at the top of S&P 500. I will be concerned. Now, after going through the stock concentration, today I'm not that worried because, damn, those companies' businesses are great. Even if an individual stock picker, you're not a passive investor, you're David Einhorn, or you are, Warren Buffett, or you are, Steve Cohen, you will still go and pick up these top 7 companies because those businesses are great. Let's say, even if market is irrationally, everyone because it's putting money in the markets, and we have an unprofitable company sitting on the top, one day market will correct, profitable companies will become top, and then but the S&P will have a bigger impact from the profitable company. So I'm not worried that much because whichever company is at the top, they will always be have a much bigger impact on S&P. But they aren't on sale now. Oh yeah, I mean, great. You have to pay up for good businesses. So either invest via Benjamin Graham way, wherein I will want to pick up the companies that are cheap because I don't want to pay, or Charlie Munger way, it is much better to pay up and buy a great businesses. Now, when I make the statement, I mean, there is, of course, at a price at which every business could be, any business could be a horrible investment. A great business could be a horrible investment, or a bad business could be a great investment, depending on what price we pay. So I'm not willing to pick any more NVIDIA at current price. It could be a great, NVIDIA's business is like 60% margin, growing 100%. And almost no competition, right? It has cornered what 80% of a GPU market, but it's a great business. Could be a bad investment if I overpay for it. I'm not sure my thesis is today if I buy it, I'm overpaying for it, right? Market will, tell me I'm wrong after 5 years. Who knows? So yeah, they are not on sale, but I like some of them may not be as overpriced, but these will be expensive. We cannot get great businesses at cheaper prices because the information is available for everyone. Earlier, 20, 30 years ago, it was possible to find it because there was information asymmetry. We don't have an information asymmetry anymore. So the moment someone finds a great businesses, the other people will also say, why do I also want to invest in that? And it becomes expensive. But there is a difference between expensive and egregiously expensive. Other stuff, Bird that couldn't fly any longer. Bird, which was known for e-scooters, also filed for it didn't file for bankruptcy. I guess I don't know, for whatever reason I came across this, but it was the fastest crash and burn. Yes, it was pumped up by VCs at $2.5 billion, IPO'd in 2021 via SPAC, another SPAC, crashed and filed for, it actually bankrupt. It filed for bankruptcy 2 years. Didn't take any time, just 2 years. It's bankrupt, right? Now currently valued at 700K. This screenshot is a week old. I don't know how much is it value right now. And remember, it has a 54 million sales in September 2023. That was the last quarterly report because then it filed for bankruptcy. So next time you tell me this company is growing its sales gangbusters, forgive me, I may be skeptical. I've seen many companies who had a tons of sales and then end up into, this position. What is Bird now worth? That's Bird. Overview. Last 12-month revenue is $228 million. And can you imagine? And it is trading for 713,000. Isn't that crazy? Oh, sorry. Probably this last 12 months will be September 23rd, because after that they have not reported results. So we really don't know what they are doing now. But imagine this company, 9 months ago, this company had done almost $250 billion in revenue. Just 9 months ago. And now it is trading at 700K. You can buy this company, be a CEO, be the owner of this company. All you need is just 700K. So the sale growth is not the reason. I mean, it used to be when I was naive. I used to look at, wow, growing 60% year over year, 70% year over year. Great. Right? Look at price to sales ratio. It's not that expensive. But now I've seen many, many companies growing their sales gangbusters and joining the ranks of like Bird. Increasing sale is not everything. It grew 132% in 2021. Right? And 2 years later, it's gone bankrupt. All right, that's the next one. So we have 5 minutes. Let's go through some stocks maybe. Or we can come to Snowflake later. Does that, if your time permits? There are a few stocks that have made some news. Or maybe we can cover Snowflake. Or let's talk about Snowflake. What does majority say? Snowflake, or let's go through individual stocks? Thanks. Yeah, you're welcome, Tom. Still able to hear me? Okay. All right, I have one vote which says, okay, let's focus on stock. Okay. Speak up while you have a turn. All right, I'm going on stocks. Then we can come back to Snowflake if time is there. So we saw a big bounce on tech stocks this week, of course, led by who else other than NVIDIA? NVIDIA was like up 7%. It jumped up 7% on Tuesday, 226. It was above $3 trillion, blah, blah, blah. Dan Ives says these four companies, Microsoft, Apple, NVIDIA, and Amazon, it says this bull run has still got a lot of oxygen left in it for 2 to 3 years, right? If you think Dan Ives is saying it, okay, I'm not saying it. It says, and they're in a race to reach $4 trillion. Like T has become so commonplace now. We don't even think about saying four before we say $4 trillion. So here's a question that I have. Today, and Amazon also became a $2 trillion company this week. Today, we have, how did I miss GOO? Google is more than 2 trillion, right? Yeah. So we have these 5 companies that are $2 trillion. Question. Let's take a guess. At the end of 2026, which one do you think will be valued less than $2 trillion? These are, at the end of 2026. Take a guess. So I see one says NVIDIA. Anyone else? Amazon will be less than 2 trillion. Okay. What's your thought process? NVIDIA, I guess, she understands because, hey, maybe today's, why don't you say, what do you think NVIDIA will drop out of this 2 trillion club? Move too fast. Okay, Ramesh is saying that NVIDIA. So Tim, your thought process, you have a different answer. So why did you enlighten us with, why do you think Amazon will not be a $2 trillion company? You can unmute yourself.
I was typing furiously. I think that they're trying to transition to the only part of their business that's truly profitable, which is AWS. And that's becoming a bit of a, let's say, a monkey fight with depending on who's actually going to win. They have a strong position now, but out of those 5, I think they're the ones that they're up against Microsoft and Google. And AWS may not be enough to carry them all the way through the $2 trillion valuation. Their core business, they're trying to actually get out of. They're becoming more of a logistics company in that end of it. And like you said, with Shopify, there are other alternatives than being in that particular Amazon market as you see the aggregators fail. So it all depends on AWS. It's a one-trick pony.
Yeah, or maybe I could say 1.25 trick pony because their advertising business is now a $50 billion business, annual business, which didn't even find a place in their earnings report 2 years ago. But okay, that's the only thing I want to just do is, hey, look through the thought process, what you guys are thinking. And future is unknown anyway. But I like your process of, hey, it's a one-trick pony. All the valuation is coming from AWS. And hence, AWS will have a pressure coming from already, like Azure is growing. Now, Oracle is also flexing its muscle. So you got Azure, Google, Oracle. So AWS doesn't have a monopoly. And hence, you think that it may not be, Amazon may not stay as a $2 trillion company. Okay. It's your thought process. So thank you for sharing. Kristen says NVIDIA. Ash says Google facing the biggest threat from competitors like Perplexity and ChatGPT. Didn't Google already killed killed Perplexity by including their overview on the Google search? I thought that was the kind of hey, by announcing that they kind of killed perplexity because now Google not only shows the curated results, but it also gives you the sources from where it has actually used to create the results. I think that was a perplexity's USP, was that ChatGPT will just tell you the answer. You don't know how much hallucination has happened. You don't know what the source is. Perplexity came with, I'll tell you the answer, and I'll also tell you the sources which I've gleaned through to get the answer. And Google started doing it with their search AI, which they announced during their, whatever, that Google I/O. So I'm not sure. I mean, but in terms of, if you think that their I/Os, I mean, if they are, they won't be, better than Perplexity or ChatGPT, maybe. Okay. By showing the curated results, those revenue from link-based ads, so I think Google loses anyway. Yeah, that's a good thought. But I don't know, the economics. So no one has yet figured out how to make money from this AI stuff. So neither Google has figured out, let's say if you click on that, under their AI overview where they show you where they pick the data from, will placement of that have a more value and more expensive than the general search? Who knows? We don't know the economics, but I like thinking in that direction. Alfred says Microsoft wants to go into monthly subscription on the OS, but probably lose many customers and Amazon. I think Microsoft losing customers sounds little, I don't know. I mean, they got such a huge moat with the Microsoft Office that is like undeletable software, especially when it comes to the corporates. So will the monthly subscription on OS will cause that much harm? I don't know, but then Microsoft also has the Azure. And about the AI. So, okay, Lil say thank you very much. Oh, okay, you're welcome. Tom says it depends on whether AI actually starts generating massive profits. I am more if everybody is integrating AI into the business and becomes less about AI, more important about business. That's exactly the point. Is so when the other companies, when you're looking at AI today, the market is rewarding AI in two forms. Number one, you are a provider of AI models. Number two, you are a consumer of AI models to improve your business. So I think that the number two cases like when a Kroger CEO comes and talks about AI for 20 times in the earnings call, that is BS. Because Kroger, you're not selling anything related to AI. You are selling groceries. And if you are using AI to become better in, let's say, your supply chain management or your inventory management, so is Walmart. So that it will be competed away. And I think it's a profile. That's what the Modron says, right? If everyone has it, then no one has it. Early 1990s, having a website was a competitive advantage. Few years later, everyone had it. It's no longer a competitive advantage. Having an e-commerce was a competitive advantage in 2000, 2001. Now you come and talk about on your earnings call, hey, you can buy it online. No longer a competitive advantage because everyone has it. Right? Having a computers were competitive advantage in 1960s, 1970s. Now you can't say, okay, I got a ERP software is competitive advantage. Who cares? It's a table stakes. So for the companies that are using AI, it will become table stakes. It will become more important what it does for your business. And I don't think it's going to increase the competitiveness, because your competitors will also do it, right? It's not exclusive to you. But the companies that are providing the software or providing the AI tools, they will make business. So when it comes to AI, I won't be a bullish on, let's say, I'm just pick up any company which is a non-A company. Let's say Walmart coming and talking about how they're using AI. Airlines coming and talking about how they're using AI to figure out predictive maintenance. And let's say GE comes and say we are using AI to do a turbine and find out the flaw before it happens. And that's a competitive advantage. Rolls-Royce is going to do the same thing, or your other competitors will going to do the same thing. You don't have exclusivity to using AI. All right. So thank you for sharing your thoughts. But yeah, it's more about your business. Rivian electrified the markets this week because they had a $5 billion agreement with Volkswagen. Right. So of course, Rivian is an EV company, needs cash to run its business. Like we see, making cars is not easy. So what's in this for? So basically, this investment serves two purposes. It gives us substantial cash. So Rivian is going to get immediately $1 billion. So which means they can continue to run their plants. Looks like they have a new model R2, whose production they need to ramp, so it will help in doing that. Number two is Volkswagen and Rivian are going to form a joint subsidiary, and Volkswagen will be using Rivian's software for autonomous driving or whatever. That software nowadays we have like SDV, right? Software defined vehicles. So Volkswagen is gonna use Rivian's software across on Volkswagen automobiles also. So the cost of developing the whole system, right, becomes much less, because now your cost is spread over multiple vehicles. So it will reduce the overall cost of the cars for Rivian. So which are both the things are very important. I talked about, they work on a software for the respective vehicles. So they're gonna get $1 billion immediately. Additional will come through the joint venture. So it's not they're gonna get $5 billion right now. They get $1 billion, live, breathe, create model R2, and then let's create a joint venture in which we will have another additional $4 billion over a period of time. Okay. So I think market really liked it. And Rivian stock was, I guess, this was up nicely. Oh, not this one. This is not a pretty picture. Okay. Let's go for, have 5 days, 5 minutes. Yeah, this is a pretty picture, right? So what Rivian was stock at $12, up 50% to $18. And then because that was when the announcement came, and then they realized, oh, I'm not going to get $5 billion tomorrow. Right? Now, I was just thinking, is it more important for Volkswagen or Rivian? Because Volkswagen is also a little bit in a desperation mode. They have forced similar partnerships with Chinese EV automaker also. So I guess Volkswagen seems that they've lost the battle against Tesla and others when it comes to the EV and basically the whole software that runs it. So they are partnering up with EV manufacturers, I guess, across countries to make sure that they still stay relevant. But time will tell. I don't own any position in Rivian, but I'll watch it. Another comment from Tom. I'm not sure the companies providing AI will be in a position like Microsoft was with Windows operating system. At some point, AI will start generating itself. Although it will be a scary day. Machines taking it over. The next one is Kitty and the dog. Oh man, this guy can't seem to be, stop posting these pictures. So suddenly, I saw, and anyone guess the reference? So Roaring Kitty posted this picture. Tell me what happened next. Any guesses what happened next? Don't Google. Yeah, Tim got it right. and Chewy exploded. What the heck have we come on to, right? Anyway. So I don't know, it's a quid pro quo. Tim says, I own some. Hopefully you sold it because it exploded and then came back down. Right. I mean, I guess it exploded, and it was halted, and then it gave up everything. But gosh, yeah, I think there are some algos which are based on whatever he posted and goes and not only this, I think there's another one, Bark. All dog related stuff went up. So maybe if you had an NFT of your dog, maybe that could have also gone up. Who knows? So anyway, I don't know. Is it Roaring Kitty and Ryan Cohen have a quid pro quo going on? Because Ryan Cohen, he took a stake in GME, right? For some, I don't know if he's still the CEO, but he was kind of a CEO, right? A CEO of GME, in which Roaring Kitty got his whole fame. And now Ryan Cohen was one of the founders of Chewy, right? And I'm sure he still holds, millions of shares of Chewy because of one of the founders. And so, yeah, I guess Kitty and the dogs are helping each other here. Right? So anyway, little bit fun. Kitty ran away. Personally, I like Toyota. I miss them when they were 193 because all my cash is in T-bills. I haven't looked at Toyota as a company. I mean, despite the fact that all the cars in our household are all Toyotas, I haven't invested in Toyota. I didn't even look at this Toyota as a company yet. Oh, what's the ticker? Toyota. And bigger question is it optionable? Poyota TM. So this must be Japanese yen. Yeah, I mean, 11% operating margin for an auto company, not bad. Yeah. All right, Nike. Nike reported results. Looks like they didn't put the right foot forward. Stock is down 25% after earnings. So what happened with Nike? They had a bad, of course, they talk about macro uncertainty, right? Which is more like geopolitical stuff. And also at a macro level, consumers are being pinched, worsening forex effects and softness in China, right? So their adjusted profits were higher, but revenue actually fell 2%, and the Wall Street was actually expecting a gain of 1%. So like completely opposite. And then they also acknowledge the lack of innovation at Nike, and competitors have gained traction in fitness and running categories. So I guess nowadays I see a lot more discussions around on ON sportswear brand. Then you got Hoka, Dockers, right? Nike has got tons of competition. So, and number two looks like weakness in China, which is one of the big markets for Nike, doesn't bode well. And a lot of folks are focusing on athleisure, right? And I guess they'll have to reinvent. But what I found surprising was the margins from their direct to customer. So Nike earlier used to sell only through the retailers like Foot Lockers, etc. Then they started doing a direct to customers. So it looks like the DTC isn't as profitable as I thought it would be. So there's a lot of valuation in Nike was also built in, saying if you go direct to consumers, scale that business, it's a much bigger margin business. Because you don't have to pay to middlemen or middle retailers. And Nike was scaling that business. So that was a little surprised to know that the DTC business, the profitability of the DTC business was less than what kind of a market was expecting. So I guess that also has to do something with this drastic fall that we are seeing in Nike. So yeah, look at the business if you're holding Nike. I don't hold any. Oh, I should give you disclaimers on. I don't hold any. Okay, of course, you've seen I hold all of them. I don't hold any Rivian, neither Volkswagen. I have no position in Chewy or Kitty. I don't have any positions in Nike. Walgreens. I have no positions in Walgreens as well, but Walgreens fell like 25% on Thursday. And for year to date, Walgreens is down, what, 55%. Right. So much so for dividend. What's this dividend yield? What are they showing as a dividend yield? Let's show the yield.
I got a question. About
Yes.
2 years ago, Newsom said Walgreens isn't going to be California hospital exclusive distributor. What does that mean? And was it pulled through? Because CVS really sucks.
Well, I think so I don't know. He said that Walgreens will not be in California.
No, exclusive distributor at hospitals.
Oh, okay. Yeah, I don't know. I mean, I've not been tracking this company, so I don't know what he might have said, but like 8.27%, right? Looks very attractive, but this isn't even sustainable. So I guess folks were holding this because the yield was attractive even before the fall that we have seen on after earnings. It will still be attractively at what, 5% plus. But there's a reason why that is why I get a little suspicious if the yield is too high. It means, hey, why is the pricing so low? Is it even sustainable? Am I, run a risk of getting my capital investment down to zero while trying to generate some income from the yield? Right? So Walgreens looks to be that case. The results were weaker than expected. Net income tripled to 344 million, right? That's why I don't pay too much emphasis on the net income. This is an accounting income. Right? I've not looked at their P&L to see is it coming from operations or is it coming from some one-time impact. But the big change was the earnings guidance being cut from 3.2 to 3.35 to 2.8. And this is the second time that they cut their guidance. So I think the guidance killed the stock. So they also said they'll close some unprofitable stores and push back on some products which is low margin. So I guess, I mean, Now the bigger question, is it a value play or is it a value trap? Right? 8% yield is attractive, right? Don't get me wrong. I mean, 8%. And if you think that the stock could bounce back, the business could become better, then it is a value play. But buying a stock at 8% when the business could go down to zero, it's a value trap. As an investor, I think that's what we need to think about is, will this company survive or will it go the right way? That's a bigger question. My thought process is, I think it's being squeezed because we're seeing that Mark Cuban's cost plus. We got Amazon coming into the retail online deliveries. There was one more pharmacy, I forgot. So they are facing competition from a lot of these online, basically, pharmacies. Number two, regulators are trying to keep the prices of the drugs down. So that pressure also. Plus, they got almost $30 billion of obligations that they still need to, abide by. So trading at 4.2 times PE. That S&P is trading at what, 29, 28, whatever. This may be a value trap though. So don't get, okay, RX, yeah, good RX. Yeah. So don't get attracted towards this 8%. Double click it, see why it is 8%. Yeah. So in an attempt to get income, make sure a principal is secured. This might be a case where it may lose I don't know. Business, time will tell. We'll have to wait for another couple of quarters, maybe 4 quarters, to see if there's a turnaround in the business. Right? Again, I never owned the stock, so I don't know the details of who the management is, how they're performing. Finally, I guess the last one on the stock side is, and then we'll call it a day, it's 12:23, is Hims and Hers. So in 225, we did a stock deep dive on Hims and Hers. Stock was up almost 200%, but didn't score well on the things that I wanted to look at. So I'm staying away, but there was a short report on this. I don't know whether, of course, there's a lot of the stock has enjoyed a lot of tailwind from GLP-1 drug. And the report was that the pharmacy that Hims and Hers is using to create that GLP-1 compound has had regulatory troubles in the past. Some of the folks associated with that pharmacy were indicted by Justice Department, blah, blah, blah. So that was a short report saying, the company is not really worth where it is trading right now. So you do your own study. I mean, I wasn't interested in the business just from, forget about GLP-1, but just from the other business perspective also. So I want to look in, if you are joining recently, go and look in session 225. We did a deep dive and scored on financials, business, risk, management, other soft factors, and it scored very poorly. So I was like, I don't want to waste my time on the stock. Right? Stock overall, I mean, stock has done pretty good for the year. Can't complain that if you own the stock at the start, it's up more than 100% for the year. Doesn't mean that the business is actually worth more than 100%. I really didn't like that business. And I've seen many these telehealth providers come and go. Right? So I'm a little more cautious on this one. And the recent tailwind was all because of the GLP-1, which today they can do it because there's a shortage of a drug. So Tomorrow, if that drug shortage goes away, that tailwind is gone. So that was another stock I wanted to talk. Yeah, let's stop right here. We'll cover Snowflake maybe in our next meeting. Any other questions? 4 or 5 more minutes I can hang around. Anything else? Any other stock that you're looking at? She says if you have T-bills as collateral, you can still buy a stock and check your broker. Yeah, if you bought a T-bills from the brokerage firm, or if you ever bought T-bills on Treasury Direct, how do you then loan it to broker? All the cash is in Roth. Yeah, Roth, no margins. Cool. No other questions? All good. All right. I guess that's it for today. Yeah, go ahead.
Oh, can you talk about New York Community Bank? Whether we want to, it's thinking of going a reverse IPO, reverse split.
So isn't that the bank which had taken over some other bank and then had its own troubles?
I don't know about taking over, but it collapsed about half a year ago. NYC, I don't know, the XNYS or something is a stock symbol.
I remember talking about New York Community Bank a few months ago. I mean, a reverse split stock split is never a good news anyway. The reason they have to do it because the stock is trading below the threshold of what the exchange may have. So, for example, Nasdaq will have is it Nasdaq or NYSE? I guess Nasdaq. They have a threshold of that if your stock is below $1 for, I guess, 90 days, then they will delist you. So you will see companies that stock have fallen so much that it is trading below $1, and then they have to do a reverse split just to decrease the number of shares, but to push up the price of individual share by more than $1. So reverse split is never good. Companies don't do reverse split if their business is doing good.
And then 23andMe, I bought probably 1,000 shares at 76 cents, but now it's at 30 cents, and it's been under $1 for 9 months. So it's been under $1 for 9 months. So does that sound like corruption to you?
No, 23. What happened?
ME.
Okay, so let's go to 23. So
about 9 months, it's been underneath $1.
no, I think so. Where is it trading?
40 cents.
No, which exchange does it trade? I guess Nasdaq ruling is 23andMe stock. It is on Nasdaq. So I thought Nasdaq has got
ME. ME is a symbol.
Yeah, Nasdaq stock delisting rules. I thought it's $1. Oh, company has 180 calendar days.
But it's been 9 months.
No. So okay, how long a stock ends for? 30. Okay, so it's like close below 30 consecutive days. To do maybe so I guess they may have appealed, etc., and they might have gotten some respite. Who knows? So there could be, but these they do have some rules around delistings. But my question is, reverse split is never a good news for business.
Mhm.
So if you ask me, do you have any thoughts? I'm like, I'm not touching this.
Okay, thank you.
I remember this. I mean, this was the bank which took over a failed bank and then it itself failed, something like that. It says NYCB is like $3.22. And it is, yeah, sorry. Your question was 23andMe is trading at that. Yeah.
Oh no, my question was NYCB, but I mentioned for people under $1, and 23andMe hasn't been that. You don't have to. That wasn't a question. I just asked one question. Thank you.
Yeah. Okay.
Don't buy. That's your answer. Thank you.
No, you're welcome. CVNA, Carvana. The stock has been on tear on Carvana, right? If I recall correctly, yeah. So that was like, it was what, 30, but not this one. I don't know what the heck I'm looking at. This was like 10 or some $10 stock some part of a time. Yeah, 6. Yeah, now looked at Carvana. I mean, this is like car ATM machines. I had a different concerns with, wow. Okay, I don't like this. Like what, they increase their share by 100%. No, operating margins are so low. Maybe in 2024 they turned around. Sales are growing at, of course, when 2021, because of COVID, all the new manufacturing was not happening. And hence they grew. The only way you could get car is through a resale. So they grew 129%. 2023, not much. So other income expense on it. Yeah, doesn't look to be the great business. I mean, despite what the stock has done. So one of the, was it Carvana's, I guess, one of the big business model of many of these companies are not, money doesn't come from selling cars, but money comes from selling the loans that the car consumers take on. They securitize the loan and sell it to investors, right? So if market thinks that the interest rates are going down, then the attractiveness of those loans become, better. I mean, they become more attractive. Because let's say if you're doing right now, if you go for auto loan, you're paying what, 6, 7, 9%, right? And now imagine if I'm thinking the Fed is going to cut interest rates, or that the interest rates is going to go down in future. Me getting a 9% loan, buying a 9% loan, not me getting a 9% loan, but me buying the cash flows from a 9% loan becomes more attractive. If the interest rates are going higher, I can make 6% in treasury bills. Then why do I need to take a risk on an auto loan giving me 9%? So I guess that also has something to do with, I guess, with the stock. Otherwise, just from looking at margins, pretty bad. And I think, yeah, so I'll have to dig deeper to see what is market so enthusiastic about Carvana. Has it done something great in recent quarters? Maybe only in the last quarter. Yeah, the revenue has grown 17%. And they turned the corner on operating income. So maybe that's a good news. They now know how to make money from their business, and hence market is now saying, okay, now they have turned the corner. Because if you see, they've been on negative operating income for what? However many quarters. Looks like they've been always negative operating income, and then 132 million, 134 million. That's a good one. I guess that may be another case. Can you please share the details how you set up a workstation? And what's a good setup for trading option? Example, optimum number of screens, standing desks, etc. So I have only 2 screens. The reason I have 2 screens is because I don't have to switch tabs, etc. I don't have like 6 screens. For me, I don't do day trading. I don't need to look at 10 charts, right? I only want think or swim or Tastiver. These are the only 2. So I'm not a very active day trader. And I do have a desk, basically those motor powered desks. So if I were to stand, I'll stand. If I were to sit, I can sit. But yeah, you won't, I don't know what else to tell you. I don't have a big setup. I have 2 screens for my trading. Overall on my table, there are 3 screens, but then I have another machine.
Thank you. Yeah, I was just curious as to like if you keep like think and swim on the right and something else on the left.
No, I have a think or swim because then I'm reading something else, so I need my other screen on which I read. But yeah, I mean, so like some of the traders that you'll see having 8 screens, 6 screens, on which 5 of them will be running some charts. I don't run those minute charts or hourly charts. I'm my 1 year, 1 day chart. Because I don't trade on weekly or daily basis anyway. Oh, so 23 and me appealed and granted extension. Yeah. So yeah, that's last NU. So NU will take more time. It's a new bank. It's a neo bank in Brazil, growing like crazy. I think I reviewed it long back when it came IPO, and I said I liked it. In terms of from their business perspective. But then in 2021, I think 2022, it sold off probably along with all the others. I've not looked at since then, but I think it's if it is not the biggest, maybe it is very close to the in terms of number of customers. And I recall they were like had almost as many number of customers, online customers, as like Bank of America has. But I'll have to look into their financials and all that. And there's the last one. New holdings. Yeah, they've been growing like crazy. Quarterly. Let's look at yearly. 60% growth. Yeah. But remember, it's a banking company. At the end of the day, it's a fintech, it's a bank. Okay, it's not and it's a regulated industry. It's not a social media company. So with that, we have to keep in mind. So 48% gross margin. I mean, it's and not true. So they had a huge share dilution. Maybe they did a secondary offering, I guess. And it is actually GAAP profitable with a free cash flow as well. How much is the... Oh, okay. So looking here, CapEx, yeah, even accounting for share-based compensation, they are still able to generate some free cash flow, which is good for a company of that size. Now, 15% free cash flow margin. Now, that's impressive. Now, I think this looks, again, this is what 2 minutes. But this is something that we could investigate further and drill down maybe in some of our next sessions. But it's not like New York Community Bank where I would say, oh, I don't want to waste my time on this. New Bank is where I would, be open to investigate more, because this looks like the company which, we can spend some more. It is not a reject outright. All right, guys. Sorry, we took too long today, but I hope this was useful for you and you learned as much as I learned in this session. So thank you for showing up. For our next Wednesday, we're gonna talk about, and I will set it up on Meetup. We're gonna talk about Delta, the option Greek Delta, and yeah, that is, of the two most important Greeks if you're dealing in options, and it tells us a lot of stuff. So if you are interested in options, don't miss that session. So that will be on Wednesday from 6 p.m. to 8 p.m. So I'll see some of you over there. If not, we'll talk again next Saturday, same time. Thank you everyone for attending today. Bye-bye. You're welcome, guys. Okay. And the Zoom interface. Okay, this will, okay.